Welcome back. I hope you had a wonderful coffee break. That was a very interesting morning. I think, a wonderful opening keynote where we were reminded, once again, this is the only planet we have and there is no planet B. And then the second very timely panel on geopolitical conflict. Unfortunately, as an American, I heard the name of the 45th president far too often for my liking, so hopefully I will forget that for the rest of the day. I'm going to hand it over to my colleague Lawrence Fletcher, hedge fund correspondent of the FT, and his panel is looking at SFDR, the distribution challenges and opportunities for managers.
Thanks, Liz. Good morning. Welcome to this panel on SFDR. My name is Lawrence Fletcher. I'm hedge fund correspondent at the Financial Times. I'm delighted to be joined by a fantastic panel for this discussion. We have on my left Vincent Ingham, who is Director of Regulatory Policy at EFAMA, where he coordinates the association's work on EU and international regulatory developments. Next, we have Aleksandra Njagulj, who is Managing Director, Global Head of ESG for Real Estate at DWS. She's responsible for ESG integration across global real estate portfolios. Next, we have Elizabeth Gillam, who is Head of EU Government Relations and Public Policy at Invesco, where she advises on public policy and political developments in Europe. And finally, we have Evert van Valsum, who is Head of Investors and Issuers Department at ESMA. He is responsible for investor protection, asset management, corporate finance, corporate reporting, sustainable finance, and supervisory convergence coordination. I think I've got that right. Thank you so much for joining us. We're going to have a discussion, and then hopefully we'll have some time for questions at the end. So please do have a think in the room and online of what you'd like to ask the panel. But the EU's key SFDR legislation entered into force last year, with Level 2, the regulatory technical standards, due to come into effect next year. This is clearly a major opportunity for the European fund management industry, but it also presents a major challenge as well. Can I start with Elizabeth? It'd be great to get your thoughts. What's been your experience at Invesco dealing with the implementation of SFDR, and what are the main issues you're facing?
Thanks, Lawrence, and good morning, everyone. So I think the first thing to mention about SFDR, before I go into all of the challenges, which makes this often sound very negative, is that it has been a massive catalyst for ESG investing across Europe. Particularly with the triggering of the Level 1, we have seen, an exponential growth in flows into ESG funds, particularly driven by our clients and also distributors who now see particularly SFDR as providing that greater transparency. And although we'll come on to it, some sort of comfort in terms of labeling, we often talk about Article 8 and Article 9, and that's very much been the game in town for the last few months. But that's not to say it hasn't been a challenge, and I would say that I would group the challenges into sort of three broad categories. And I don't want to hog too much because I know that my colleagues on the panel will go into more detail on some of these. I think the first group of challenges is remembering that the overarching objective, which was to help clients make more informed decisions. And particularly when we're speaking about retail clients, but also more sophisticated clients, we've developed a very complicated regulatory regime full of very complicated terminology when we're talking about taxonomy or sustainable investments or principal adverse impact. I've been working on ESG investing for 7 years, and I've just got to the point that my mum knows what ESG stands for. And she's not alone. We did a study last year that found that only 14% of the average retail investors recognize the term ESG. And most of them couldn't tell you what it stood for, or indeed what it meant. And they have very different understandings. And so, particularly when we look ahead to the introduction of the MiFID requirements on sustainability preferences in summer, we've got a huge uphill struggle in terms of helping people actually understand what these new terms are and how they relate to what they actually are looking for when we think about ESG investing. The second group of challenges, I think, is around recognizing that we as asset managers are intermediaries as part of a longer investment chain. And some of the coherence and sequencing around that investment chain has been lacking. So clearly there's a huge demand for example, ESG data. We have to start reporting, but the corporates haven't. And so there are huge data gaps that we're having to address, whether it's taxonomy or principal adverse impacts or other elements like that. But also other parts of the value chain we rely on when we think about benchmark providers for many of our funds that have a benchmark as a reference They have the different rules, again, different interpretations, different requirements. And then finally, the distributors have slightly different rules as well. So making sure that all of this flows together and matches up and ultimately develops a coherent whole. And then the final one is, I think, recognizing the diversity of our industry, both in terms of the types of asset managers, the types of asset classes, but also the markets we serve. ESG is not homogenous, and if you ask a German investor whether they think nuclear is green, you will get a different answer than if you ask a French person, potentially. But also different requirements around the world, and many asset managers, are not just servicing European clients, but will have global business models. And so trying to knit together all of these different requirements and addressing all of these different challenges to create that critical mass and that scalability continues to be a challenge. So I'll maybe pause there and leave space for my colleagues to chip in on their additional points.
Fantastic. Thanks, Elizabeth. Sasha, can I get your thoughts as well? And you come from a sort of alternatives perspective. What's your views here?
Well, in a way, it was easy for alternatives, especially for real estate, because this whole issue of what is a sustainable asset, doesn't quite apply as a challenge to buildings, because we have known for decades what a sustainable building is. Of course, the requirements keep increasing. But the first sustainability certification came out in 1990s. BRE from UK came up with BREEAM, and then you had a whole smorgasbord of certifications around. On a portfolio level, we had GRESB, or Global Real Estate Sustainability Benchmark, since 2008. So we have been collecting that data, we have been measuring our performance, we had third-party certification benchmarking in place, all of that was kind of in place. So part of what SFDR requires for us is easy, because we already, if we have it, we have it. If we don't, we're still working on it. But where it doesn't quite work is the whole, if you like, alternatives is always a little bit like a second child. Liquids is the first. The RFIs that we see are geared to liquids. The regulation that we see is geared to liquids. So certain requirements and certain ways of reporting and concepts that exist in SFDR simply don't apply to alternatives. So and especially to real estate. So let's say, index question that's in Article 8 and Article 9, or way to prove that you have a sustainable investment. Simply, we don't have an index as such. So there's a little bit to challenge that. To how do you then comply with legislation that's not quite there for us.
Sure, thank you. Vincent, what are you picking up at an industry level? What have you sort of gathered, and what are your thoughts so far?
So the first thing I can perhaps say is that I think the SFDR implementation has not been a walk in the park for the industry, and there's been considerable efforts put by fund managers to implement a new regulation, and I would say to implement it in good faith and on a best effort basis. And I think the industry is confident that once the entire sustainable finance regulation will be in place, not just SFDR, but also CSRD, the taxonomy regulation, it will really have the potential to deliver on their objectives. And we were reminded earlier this morning, how important it is to indeed move towards a more sustainable economic model and help support the transition. So this is very important, and the industry is really supportive, and I believe doing their bits in good faith. However, there's still some way to go, and a few obstacles along the way. Let me just highlight very briefly a couple of them. I believe data availability, as was already mentioned by Elizabeth, is the number one issue that asset managers have to grapple with today when talking about SFDR implementation. And this is particularly true for the disclosures that will come under the reporting obligations that will come under the level 2 templates. And so, like PAI indicators, just to name one. So obviously, the situation will probably improve over time, gradually, with increasing standardization, with the development of international convergence under the auspices of the ISSB, EFRAG. But all this will probably, if we are realistic, take a few more years to bed down. And so I believe it's very important during this transitional phase or this phasing of the SFDR implementation that we are able to rely also on, I'd say, the understanding and the flexibility from the regulators, and concepts like a proportionate and risk-based supervisory approach to the issues would certainly be welcomed. The fact that the SFDR regulation is coming by bits and pieces, if you allow me the expression, and that market participants had to start applying the level 1 regulation when the level 2 measures were not yet available, certainly did not help either. And the situation was only exacerbated by a number of legal uncertainties, questions of interpretations that were identified and raised quite early on, I believe, by the industry, and some of which were, by the way, relayed or asked by the ESAs to the European Commission. Some of those questions have, in the meantime, been answered, for instance, by the recently published regulatory technical standards. But a number of those questions are still pending, unanswered, and this is a real challenge, of course, for all of those who have to apply this complex regulation under a very tight deadline. Last point I would like to mention is because of this, precisely of this prolonged absence of detailed level 2 rules of implementation, this has led to national fragmentation because, in a way, naturally, to fill in the vacuum, a number of national authorities have developed their own guidelines towards the implementation of this SFDR regulation. And this is creating issues of their own, not only for product manufacturers who are confronted with difficulties when they are distributing their products cross borders, but also, and probably more importantly, for the end investors who are confronted with the difficulty to compare products on the basis of different guidelines, for instance, around Article 8 or Article 9. So those are the main issues the industry is facing today, I would say.
Fantastic, thank you. And to Everett, I mean, obviously it's a very complex area, and we don't expect you to have answers for every issue that's raised so far, but could you give us a regulator's perspective on sort of where we're at? What is your view of sort of, you know, the concerns expressed here, and how do we move forward?
Yeah, I think the concerns are very familiar to us. It's not like we hear this for the first time. Clearly, and I'm echoing basically largely what the former speakers have mentioned. There are three things indeed I'd like to stress. First is the complexity of the regulation, how it all fits together. And that is in terms of the way it's drafted, in terms of the way they are interacting. So if you look at taxonomy regulations versus SFDR, I think there are a lot of cross references, which makes it quite difficult to navigate. And then clearly you also have the CSRD and the work that the taxonomy platform performs going forward. So the complexity of this all is quite astonishing. Second thing is clearly the sequence of things, because you have first financial market participants who get obligations through the SFDRD, so where you would have the obligations established without the data being present. I think that was already mentioned, which is quite difficult. At the same time, it's a reality that we have to face. In the context also of Europe going ahead, trying to be quick and keeping momentum, but at the same time realizing is that there's an international arena out there where you have to be aligned. And clearly the work of EFRAG there, making the European standards based on the CSRD versus the ISSB work, that is clearly something to watch. Third point is clearly, and it's related to complexity in general, is what Elizabeth already mentioned, is what will the retail investor make of this all? If you're getting the question on your sustainability preferences according to MiFID, but in general, taxonomy lines, ESG, Article 9, Article 8 products, Article 6 products. If you take your typical retail investor, it's hard to see how they would follow necessarily, certainly at this point. So quite a lot of work needs to be done there. One thing that I would like to stress, and therefore I listened very carefully to the keynote speech of Nancy when we started off, is to see the reason why we're doing this. And I know this is all painful, but at the same time, it's so important to see the broader picture and the sense of urgency around this all. What the ESAs clearly are doing is to scramble to provide guidance where that is possible. I'm saying provide guidance where it's possible because interpretation of union law cannot clearly be done by the ESAs nor ESMA. That is sent to the Commission to reply. And there, for example, you've seen at the Article 8 taxonomy regulation, a lot of frequently asked questions published by the Commission. At the same time, we're trying to keep up, and I can already predict that in a few weeks' time, we're getting more and more guidance from the ESAs on various topics on SFDR. And clearly, when the publication of our RTS on SFDR is in the OJ, we can publish also formal Q&As to take this forward. So there we're trying to provide guidance where necessary within the powers that we have. And I'll stop there.
Great, thank you. And Vincent, can I just come back to you? You mentioned about the RTS publication last month. And are there any sort of particular sort of unanswered questions that sort of came from that you'd sort of like to see answers to in the coming
Yes,
months?
there are definitely a few questions that remains unanswered even after the publication of the RTS in April. Many of them, let me just mention 3, around the PAI regime, around the definition of Article 8 and Article 9 products, and around the definition of sustainable investments. Starting maybe with the PAI regime, one question that the April 2022 RTS is not answering is the question of whether any products can be excluded from the manager's entity level report. And I'm afraid in the absence of such clarifications, it's prudent to assume that all products will need to be included in those reports. Similarly, the RTS are not providing any details on product level PAI reports, and there is also no further guidance on how to treat short positions. So those are 3 questions that clearly remain unanswered. And in this context, I should add that the mandate that has been given, at least that was made public a few days ago and given to ESMA to reframe PAI disclosures requirements came as a surprise to many of us, and not necessarily as a good one, because while the PAI regime has been widely criticized and could probably benefit from some amendments, the timing of the announcement of this new mandate, with barely 7 months to go, if I'm counting well, until the RTLs will become applicable, will not necessarily be welcomed by everyone, in particular taking into account all the efforts and the money that have already been spent in trying to comply with RTS, which may well become obsolete in a year or 2. I should add to that the breadth of the review that would come under those revised RTS is also unclear, and we are a bit concerned, I must say, about the open-ended nature of the request to extend the list of mandatory indicators, and by the request for ESMA to refine the contents of all the indicators and the respective definitions, applicable methodologies, metrics, and presentations I'm quoting here. So I may be wrong here, but this hints to me, at least, at a potential complete reworking of the PAI regime. And I guess against this background, further clarity on the scope and the timing of the review would certainly be appreciated by the industry. And it may also be appropriate for the European Commission to consider deferring the application of the RTS PAI rules if these are to be substantially amended in the next 12 months or so. So that's the very first issue, PAI regime. Very quickly, definition of Article 8-9 products. The RTS do not include further specification on the definition of Article 8 or Article 9 products, except for a few indirect references in the recitals. And importantly as well, the RTS do not set any minimum thresholds, so kind of a proportion of the portfolio that needs to be taxonomy aligned for qualifying as Article 8 products. Last, but certainly not least, for the application of Article 9, the industry would needs more guidance on whether the sustainable investments analysis needs to be conducted at entity level or at the level of the economic activity, and this is important. And regrettably, the regulatory technical standards do not define this notion in any further details, and there is also no further guidance on the open question of what contributes to E and S objective means in practice. So, again, clarifications on those points by the ESAS or by the Commission would certainly help.
Fantastic, thank you. That's
If I
very
may
extensive
jump
list.
in, I just wanted to add to,
Yes, please, yeah.
to the litany a little bit. But how do we define transitional assets? If we go back to the purpose that we listened about in Kino's speech, climate change is obviously one of the main challenges. Real estate contributes to about 40% of carbon consumption or emission rather in Europe, and most of it is due to existing buildings. So, the biggest challenge that we have in real estate is to actually fix these buildings, not build new. Now, how Article 9 is written, you need to have 100% of sustainable investments from day one, and by definition, an asset that you buy to fix is not going to be sustainable in the first place, right? So this whole transitional sustainable investment, so you're actually having the big impact on climate change, you're making the biggest contribution you can through the asset class, is not Article 9 compliant, if you like. So in the UK taxonomy, there is a transitional bucket, if you want to call it, alongside with other types of sustainable investment. So that's something that I think also could be addressed, because it has almost a perverse effect of disincentivizing investors that really want to make impact investment, really want to have a positive effect from going for investments such as this. And I would assume it also goes for the other other asset classes. If you want to fix through your investment, which is the core of impact investment, Article 9 doesn't actually work with that, whereas the purpose of Article 9 as it came out in Level 1 is, this is dedicated for resolving an environmental or social issue, and therefore it's meant to fix things, but how it's defined, it sort of works the other way around. So maybe that, if we are looking at RTS again, maybe an element of unsustainable buildings with the transitional plan would be a good way to bridge that and fix that, if you like.
Great, fantastic, thank you. Elizabeth, anything you'd like to add on this? Or?
So maybe just a couple of points. I think that we have all of these issues that we're addressing. I think one thing that we see coming through very strongly is these definitional issues that don't really match across different regulations. So to the point that was just made about real estate and transition, if you look at the taxonomy, there is a clause that says if you reduce carbon emissions of a building by 30%, you can count that capex as being a sustainable investment. And obviously we think that taxonomy is a sustainable investment. And so how do we fit these together? Another example is the climate transition or Paris-aligned benchmarks. So Article 9.3 implies that if you follow a climate transition or a Paris-aligned benchmark, you are an Article 9 product. Except those benchmarks don't reference sustainable investments and indeed have a decarbonisation objective that you reduce your carbon emissions first by either 50 or 30% in the first year and then 7% thereon. So there is this conflict around how we define what is a sustainable investment, and particularly how do we measure impact and what do we mean by that? Does it already need to be green? Are we talking only about pure play companies? In which case there's a potential issue with the Commission's definition that it needs to be almost exclusively 100% sustainable investments, because there's very few of those companies or assets that we can invest in. Or we need to accept that it is about making change and it's about engagement, it's about positive momentum. But then that requires a slightly different interpretation of sustainable investments and understanding around how we get to that positive momentum and change in those funds. So I think that there are a lot of definitional issues to be addressed. And as you say, transition is one of the big issues that we're trying to address. I think there's a similar issue with the PAIs. The PAIs are a very blunt tool, and it implies that any level of carbon emissions is an adverse impact. Obviously, if you're doing a net zero fund where you're actually specifically targeting the highest emitters, you are going to ding very highly on that PAI. But that's the whole point of the strategy. The whole point is to invest in those companies that are in high emitting sectors, but that have carbon transition plans, who have targets, and who are making a difference. So I think we need to be very clear about what we're trying to achieve here, and what good looks like, and not using very blunt definitions and blunt tools as a proxy for doing good, because we know that the reality is much more nuanced and much more complex than that.
Brilliant, thank you very much. And again, back to Everett. Again, we don't expect answers to all these questions straight away, but could you maybe give us some sort of timeline as to when sort of answers might start to come, and are there any particularly that you could address here? I mean, the issue, for instance, of transitional assets is very interesting as well. How might that be tackled?
Yeah, so the wish list of Vincent, that is quite impressive, clearly, and it's not common when you have to establish a whole reporting framework and obligations to report as financial market participants. So I'm not surprised that if you have a new legislation that is quickly being established, a lot of these questions are there. Again, I mentioned that the ESAs will be coming with guidance on various topics on SFDR. I think the two mandates that Vincent was referring to were a bit of a surprise to us as well, but we should not forget this is a highly political dossier. So in that sense, clearly the Parliament also has a big stake in what is happening, and clearly also on the principal adverse impact indicators, which are under constant scrutiny, I can tell you from personal experience, by the members of Parliament. So in that sense, I'm not really surprised. I think the two mandates, one of the mandates that we're working on, which is supposed to be very quickly, is a knock-on effect from a change in taxonomy regulation where nuclear and glass were included. So that has a knock-on effect on the SFDR disclosure, which is pretty technical and basically a follow-up on a very, very political decision that was made. And the second one is indeed to streamline the principal adverse impact indicators, which is more intriguing because what do you need to streamline? But there you see again the sequence of the work that is done on the SFDR, then the RTS, and also the taxonomy regulation and the work of the Sustainable Finance Platform, which creates also some further thinking on what is supposed to happen. I think in the area of sustainable legislation, you need to get used to changes more often. And partly it is because if you look at taxonomy aligned, that's going to be a moving target anyhow, because they're going to change the delegated regulations on the various scrutiny criteria that are used for do not significantly harm and for taxonomy alignment in general. So I think it also slightly replies to the question on transition, which is a very difficult topic, because you see in the Sustainable Finance Platform that is also something that members struggle with, and therefore also the idea to create multiple taxonomies at the same time to reflect basically is that the current taxonomy is some more aspirational in that sense. It's the greenest of the green. And you also see this in the expected taxonomy alignment going forward at this moment. That is going to be very, very low percentage, because that is about really green. But you need to have something in between where you can transition from something that is not green or dark brown even, but to make it into something that is green as such. Therefore, you need capital flows. It's really important to get this done. And I'm not talking about coal, etc., because that is something you cannot make green at all.
Fantastic, thank you. And could we dig a little bit more into perhaps the issue of data that was mentioned as well? Could one of the fund managers maybe sort of just explain or give us an example of how data is proving sort of hard to collect, and what you're doing about that, actually, how you sort of tackle that?
I'm happy to start. So I think that ESG data challenges have been around for a long time. This is not new. It's something that we've complained about ever since we've been talking really about ESG investing. I think one of the challenges that we found, in particular, so principal adverse impacts, it's a very specific set of lists with a very specific calculation methodology. For example, carbon emissions, it uses, sorry to get technical, but it uses EVIC, which was not the definition of the TCFD, for example. And it isn't the definition that the UK is using. So even when we think about, the actual categories of metrics might be the same, but actually how you calculate them can be different. And so we end up having to, toggle between 7 different versions of essentially the same metric for the same fund, depending on which regulatory regime we're trying to disclose on. Now, that's for the easy one, because carbon emissions, at least we have good data, but some of the PAIs, there is no data set, particularly around biodiversity. This is a brand new data set that many people didn't have. Other asset classes, this is just talking about listed equity and fixed income, where actually there has been a lot of reporting, but we think about other asset classes like sovereigns, etc. Those are very difficult data sets that we're still building. Ooh. Sorry.
I think it's here.
It's going to
It's
be
behind you.
Maybe I pick up while
Yeah,
they
sure, that'd be
sort
great. Yeah,
themselves.
thank you.
So from alternatives point of view, again, we have this sort of tradition. Do you want to finish?
Yeah, sure.
Okay.
So, sorry, technical malfunction. So that's one element. I think the other one, and the most challenging one that we've seen is around the taxonomy, because these are brand new criteria and require metrics and data sets that we've never had to deal with before. This is essentially building a brand new data set that nobody had before. And despite how detailed the criteria are, and you would think that that would encourage consistency, we are still seeing a huge amount of interpretation, mostly because there is no reported data to rely on. And there's a huge question around to what extent can we use estimates and proxies in that regard. But obviously, even in the future, we will only have data for European companies when they start reporting. And so trying to understand how we would measure taxonomy alignment for non-European holdings is going to be a really huge challenge.
Fantastic. Sasha,
So,
yes.
yeah, so the two, if you like, groups in alternatives, infrastructure, debt, all of that has the same problems as liquid. Real estate has primary data, so we actually manage these assets directly, so we can actually put a meter in and get the information. There's a little bit of challenge with tenants, not wanting to share the data and so on, engagement. But generally, we know what we need to do, and we have tools and databases to manage that, and have been for decades, as I said. The challenge is actually in definitions of, for example, the PI data. In order to prove that an asset is not inefficient, you need to show EPC rating. EPC rating stands for an Energy Performance Certificate, and it's mandatory for all buildings in European Union. But if you're investing in Asian assets or American assets, that doesn't exist. So you can have the greenest building in the world, and you can't prove, using this definition, that it's green. So there's a little bit of that to be fixed. And even within the European Union, the definition uses letter, so EPC A to G. In Germany and in Poland, you don't have letter ratings. So for all our German assets, for all our Polish assets, we can't prove anything. So I think, through this refinement of the technical aspects, it would be good to address those issues as well. But generally speaking, data is, apart from the tenant piece and scope 3 piece, it's well known in real estate industry and exists already.
Fantastic, thank you. Vincent, anything you'd like to add?
Not much to add, but just to say that indeed to sort out or to solve this data availability issue, I think a key point to keep in mind when completing the sustainable finance regulatory framework is to think about the alignment between the different pieces of regulation. Because asset managers quite obviously are dependent on the information and the disclosures they receive from the companies they invest in. And so there needs to be this good link there, and that's something that really needs to be kept in mind.
Fantastic, thank you. Evan, anything you'd like to add before we go to a question from online?
Yeah, again, I mentioned already the issue of data and the reverse order of legislation where reporting requirements were installed without data going on. And I think there's some hope because the CSRD and the work that EFRAG is doing on the sustainability standards, the work there is really meant to connect to being able to supply data on the principal adverse impact in SFDR, on Article 8, the taxonomy regulation, and in general, sustainability reporting. There is going to be still improvement. What is still very difficult is everything that's outside of the EU or outside of the scope of the CSRD. And for example, everything that is, the non-listed segment not being large companies, that's going to be a problem anyhow, because they're still not part of the CSRD scope, which has increased clearly, but it's still an issue also going forward. So there's always going to be this issue of finding proxies to a certain extent, certainly if you talk about indeed outside of the EU scope.
Fantastic, thank you. We've got a question here, I think, from our online audience. It says, in the meantime, while all the definitions and PAI regime are being reworked, aren't the asset managers facing a huge regulatory and reputational issue if and as soon as they start to disclose any figure in relation to the sustainable investment or PAI integration? What is, in your view, the safest way of dealing with those risks? Would you like to challenge and take that?
Yeah, well, I was looking at a fund that we portfolio that actually has a transitional strategy, and we looked at what's happening in the market, and there are some transitional funds that are saying they are Article 9, and went through local regulators and so on. But our choice was to be super conservative in anything that we report or say, so better err on a conservative side, I think, in this stage, and saying that for a German asset manager, that's like ultra conservative. Better sort of under promise and over deliver than sort of try and go into the gray zone until it's clarified. That's our view on that.
Great, fantastic. Anybody else like to chip in on that?
Yeah, I think that the industry is really stuck between a rock and a hard place, because on the one hand, the regulatory uncertainty does lead you to want to take a very conservative approach, to wait. We saw, for example, that Article 9 products did take longer to come to market because everyone was trying to work out what is a sustainable investment, where is the dividing line between Article 8 and Article 9. And we're continuing to see that. And I think, the ESMA Stakeholder Markets Group, I think, introduced a new term, which was green bleaching, which is people not wanting to make ESG claims because they're so worried about the reputational risk, and actually downplaying their ESG claims as a result. But the challenge is that obviously from a commercial and distribution perspective, particularly when the MiFID requirements come in this summer, we are going to be asked and pushed to have these higher numbers. One of the challenges with the MiFID sustainability preferences is that in many cases it's a numbers game. You will be measured on what percentage of taxonomy alignment you have, what percentage of sustainable investments you have. Never mind the fact that my definition of sustainable investments can be different to DWS's definition of sustainable investments. So we're measuring quantity, not quality. And that's going to drive us to commercially want to make higher claims, but then struggling with the regulatory stuff. So I think that, we're being very careful. We're challenging ourselves a lot about where we think, the market is, where we think it's acceptable, trying to understand with the regulators what we think is okay, and scrutinizing a lot of the claims that we think we can make, and understanding the data sets. For example, with taxonomy, I led our taxonomy implementation project. We spent 4 months doing huge amounts of due diligence on all the third-party data providers we were looking at, because we understood how complicated this was, and we wanted to be 100% sure that the data we were going to start disclosing really reflected what the regulatory requirements required us to do. And even then, we will have the data, but we are making no claims as to any minimum commitment to taxonomy in the short term, because we want to get comfortable with that data. We want to understand how it's going to behave, and that we can continue to do that, and that we know that the data is going to be fluctuating, is going to be moving around up until at least a significant minority of companies start reporting themselves, and we want to get comfortable with that before we start making any promises to clients around what we can deliver.
Fantastic, thank you. We have a few minutes left. Do we have time? Do we have any questions from the audience here? There's some people with microphones. Anybody like to ask a question? Oh, I think we have here. Yep.
Hello, can you hear me? Hello. Thank you very much. Very interesting discussion. So I'm Nancy Sage from the European Investment Bank, and I'm a rapporteur in the platform. And I just want to ask Esma, I want to pick up on this very important point you made about companies who have transition plans, and how can we value companies that are making plans to make these transitions, but which doesn't at the moment result in, when they start reporting under CSRD, that their equity is more green. How do you think we can make that a useful data point? Because in our work in the platform, we identified there is so much need for good transition planning, and ultimately that will result in CapEx reporting. But right now, when we are looking at companies, how do we distinguish, and how do you think we can value companies that are making these robust and ambitious transition plans?
Yeah, I think Nancy just popped the $1 million question, which she also raised herself during the Sustainable Finance Platform, and it's a very, very important question. I think part of the reply is what you, as platform, have designed on the plans to have multiple taxonomies in place. I think that is where you can see a possibility going forward. The problem there is clearly what is the Commission's appetite or the co-legislators' appetite to actually work on that advice and make it happen going forward, which will take certainly multiple years to do so. I think there's also this interesting discussion on, so if you have taxonomy alignment, whether you talk about turnover or whether you talk about CapEx or OpEx. And clearly, if you talk about CapEx, that could, if you have a high CapEx score, that could really show investments into making that transition going forward, compared to if you have the turnover KPI as a consequence. I think it's a difficult question because what was predicted clearly on taxonomy alignment, it's going to be very low, partly because of the green bleaching prudence that Elizabeth was saying, but also partly because it is quite a high bar to achieve. And that remains the question, how do you get then the funding going for a transition? I'm afraid, Nancy, I don't have the full reply. At the same time, it's something we need to work on with all the stakeholders involved to get this going, and certainly also in the EFRAG hemisphere.
Fantastic, thank you. I can see that we're up against time, actually, so it just remains for me to say thank you so much, Vincent. Thanks, Sasha. Thanks, Elizabeth. Thanks, Evert, for your time, and thanks for listening. Thank you.